Let's talk about iron condors. At the time I'm recording this, it is shortly after we have done, I believe it's Operation Fury, and stopping Iran from getting nuclear weapons or proliferating more of them. So we have a lot of turmoil going on in the markets right now that has increased the volatility in the markets. That's not necessarily a requisite or even the best environment for an iron condor. An iron condor is a very flexible trade. It's a very forgiving trade. What we're looking for is to not have an extreme move one way or the other. Now I have here SPY, and I like using either an index or an exchange traded fund on an index because it eliminates the individual company risk and you don't have to worry about dividends as much. You don't have to worry about earnings causing a big spike in your underlying because in this case they're one of just 500 stocks that make up this ETF. So that's the first thing that I like. Now let's look at how you construct an iron condor. It's probably easiest to think of an iron condor as two vertical spreads, both of them credit spreads. A bear call, so I'm going to sell out of the money on the call side. And then a bull put. So again, I'm going to sell out of the money on the put side. Notice there's a little bit of a skew here this morning. The prices are heavier on the put side than they are on the call side. That's just kind of reflecting our market situation. All right, so there's our iron condor. Our credit is 71 cents. We just have a 1 point spread on each of our two contracts. Both sides cannot be in trouble at the same time. Our profile looks like this. Okay. So if we were to get filled at this price, we'd probably be pretty happy with that. We could potentially make 71 cents. We could potentially lose 29 cents. Now, commissions are worth mentioning here. There are 4 commissions in this trade. And that's if everything expires worthless. If we have to pay to unwind it, we could be looking at least 6 commissions, possibly more if we get whipshot real bad. Now I'm choosing today's date. This is a 0 time to expiration trade. We're still pre-market. If we could get filled at this price, again, we'd probably be pretty happy with it because of the reward to risk ratio. Now, we could totally construct this trade in a different way. We could go way out in time. Let's say we go all the way to April 30. Almost 2 months out. You can probably hear that the markets are just opening now. And I'm going to want to get probably a few more strike prices because with all that length of time, I'm going to want to give myself a little more room. Now, something to worry about. When you start getting further out in time and further out in the money, your spreads start to get a little wider. Now they're really still quite tight, but they are wider. So we really need the computer to help us out a little bit here. I've just done one leg and take the midpoint between these two. I would even say usually you can get filled that way. That's been my experience with personal trading. Okay, I've still just got one strike apart. Okay. I've still got a pretty good reward to risk ratio, but I've also given an awful lot of time for this underlying security to move and put us in trouble. So if I'm going this far out in time, I'm going to be a lot more willing to harvest profits earlier rather than if I'm doing a day trade or a really short-term trade. I'm hoping those go to expiration and I only have to pay the commissions to get in. With this trade, I'm so far out in time, I don't want to give the market 2 months to move to me. I really don't. So I'm going to be a lot more likely to harvest my profits earlier. And so I'm probably going to give myself a wider spread. So right now I have a potential of 69 and potential of losing 31. And again, there's all those commissions that I'm going to mention, but not really include in the numbers. Let's say that I go up to a 2-point spread here. On this side, I'll have to go a little lower. So I'll go down to 262. Now let me double check. Yeah, that's still a credit spread. And yeah, that's still a credit spread. And you can see that the markets are, as we approach market open, well, we're now in market open. You heard the dinging a few moments ago. But here we are. This is still pretty good. Now another thing that'll change is the wider that I make my spreads in between my two calls or my two puts, the wider I make that, the bigger my theta will get. And the reason for that is you can see that the closer we get to at the money, the bigger the theta will get, just as a rule of thumb. And the wider apart that we get, the more different they will be. If I was looking at the first ones that we put up here, here we have a theta of 1564, and depending on the spread, it's actually showing it as higher right now. It wouldn't be, but it's showing that way. The wider I make between these two, the more capital I tie up, the greater potential loss I have, but the faster the time decay. So bear that in mind. That's probably enough for an introduction. Good luck out there.